Everyone argues about the best way to build wealth. Some swear by index funds. Others live for dividend checks. And then there's the real estate crew, cash flowing rental properties and collecting appreciation. The truth is, each path can work brilliantly or fail loudly, depending on your temperament, time, taxes and tolerance for mess. Today we're running a straight, practical comparison. Index funds versus dividend stocks versus rental real estate. By the end, you'll have a simple decision framework and a starter playbook for whichever lane fits you best. Education only, not financial advice. Begin with the goals most people actually care about. You want to grow your net worth, generate income you can rely on, avoid blowing up your risk profile, and keep your life simple enough that you'll stick with the plan for decades. Those goals map to 4 lenses: return, risk, time and effort, and liquidity. We'll score each strategy through those lenses and then show you how real humans use them in the wild. Index funds first. An index fund is a low-cost basket that owns tiny slices of many companies at once, usually the whole market. Instead of guessing winners, you own the winners, the losers, and everything in between. The edge is low fees, broad diversification, and zero need to babysit. Historically, broad markets have grown over long periods with scary drawdowns along the way, and index funds let you ride that growth while keeping costs tiny. Risk is market volatility. Prices swing, sometimes hard, but single company blowups barely register because you own thousands of names. Time and effort are minimal. Set it, automate it, rebalance occasionally. Liquidity is excellent. You can sell in seconds in an emergency, though the plan works best when you don't. The biggest challenge is psychological. You have to keep buying when headlines scream and friends chase shiny ideas. If you can do that, index funds are the simplest way to turn paychecks into ownership of the global economy. Dividend stocks next. With dividends, you still own equities, but you tilt toward companies that send you cash regularly. Fans love the psychological boost of income deposits and the idea of living off dividends someday. Pros: disciplined firms with durable cash flow. A cash stream you can reinvest while you're growing and spend later in retirement, and potential tax advantages depending on where you live and which account you use. Risks: concentration and selection. A high dividend doesn't equal a safe dividend. Payout ratios can stretch, businesses can get disrupted, and cutting the dividend usually smacks the share price at the worst time. Time and effort, higher than index funds. You research balance sheets, watch payout ratios and dividend safety, diversify across sectors, and accept that your total return may trail the market if you over-optimize for yield. Liquidity, just like other stocks, excellent. Dividend strategies shine for people who crave visible income and are willing to manage a portfolio with rules and patience. Now, rentals. Rental real estate mixes, operating a small business with owning an appreciating asset. Returns combine 4 engines: cash flow from rent, principal paydown as tenants help retire your loan, appreciation over time, and tax benefits that can be meaningful depending on jurisdiction. The power here is controlled. Leverage. With a down payment, you can control a larger asset, and modest appreciation on a big asset adds up. Risks. Leverage cuts both ways. Vacancies, repairs, bad tenants, interest rate shocks, and local policy changes can flip a spreadsheet from great to grim. Time and effort are real. Unless you hire a great property manager, you're dealing with leasing, maintenance, and tough conversations. Even with a manager, you'll make decisions, manage reserves, and read statements. Liquidity is poor. Selling a property takes time and costs money, and refinancing at the wrong moment can be painful. Rentals fit people who like operating, can handle occasional headaches, and want the mix of leverage, control, and tangible assets. Let's make this visceral with 3 profiles. Alex is a software analyst with a very busy life who hates financial clutter. Index funds are a natural fit. Alex sets an automatic contribution into a total market index fund, adds a modest international slice, and turns on a once-a-year auto-rebalance. The portfolio runs while life happens. Dividends, stock splits, interest rates, none of it requires action. The key move for Alex is consistency and increasing the contribution by 1% a year until the savings rate hits the target. Bailey is a nurse who loves the motivation of visible income. Dividend stocks click because the cash flow feels tangible. Bailey builds a diversified list across sectors, favors companies with long histories of growing dividends, and caps any single position to avoid concentration risk. Payout ratios matter, so does a margin of safety on earnings. While still in the growth phase, Bailey reinvests dividends automatically, then later can switch to taking the cash. The key move is discipline. Avoid chasing ultra-high yields, keep costs low, and remember that total return, price plus dividends, beats yield-only thinking. Casey is a project manager who likes fixing things and negotiating. Rentals make sense because Casey enjoys the business side. The playbook is clear. Study 1 or 2 zip codes, learn rents and repair costs cold, set strict buy boxes, underwrite deals for realistic cap rates, and build fat reserves for vacancies and surprises. Casey hires a property manager, treats the manager like a partner, and budgets for professional help on taxes. The key move is saying no to almost every deal, and yes, only when the numbers work on conservative assumptions. Now, raw comparisons. On expected return, all three can compound wealth, but in different ways. Index funds deliver market-level growth with minimal effort and ultra-low fees, historically excellent over decades. Dividend stocks may deliver a bit less total return than the broad market if you chase yield, but they trade that for psychological comfort and income you can see. Rentals can outperform on paper because of leverage and tax benefits, but returns are uneven and highly dependent on buying right and operating well. On risk, index funds spread company-specific risk across thousands of names. Your main risk is being forced to sell low because you didn't keep enough cash. Dividend portfolios add selection risk. The antidote is diversification and conservative payout ratios. Rentals concentrate risk in one address in one town with one set of rules. The antidotes are reserves, insurance, diligent screening, and conservative financing. On time and effort, index funds ask almost nothing from you beyond contributions and occasional rebalances. Dividend strategies ask for periodic research and maintenance. Rentals demand upfront acquisition work and ongoing management even with help. On liquidity, index funds and dividend stocks win by miles. Rentals lag, plan around that with cash reserves and long horizons. Taxes matter. Dividends can be tax-favored or not depending on your country and account. Index funds in taxable accounts can be very tax efficient because they tend to distribute fewer capital gains. Rentals have depreciation and expense deductions that can shelter income on paper, with recapture rules later. The right account and jurisdiction change outcomes, so always run after-tax math for your situation. So which lane should you pick? Use this quick temperament test. If you want maximum simplicity, minimum time, and high odds of sticking with the plan, index funds are almost unbeatable. If visible, regular income keeps you motivated and you don't mind curating a basket of companies, dividend stocks can be a rewarding tilt. Just remember, total return. If you like running small systems, can handle occasional chaos, and want the control and leverage unique to property, rentals can be powerful, provided you buy conservatively and keep reserves bulky. You can also combine them. A common blend is core index funds for the bulk, a small dividend tilt for psychological income and cash flow optionality, and a carefully selected rental or two for diversification and leverage. The mix might look like this in practice: 70% index funds for set and forget growth, 20% in a diversified dividend portfolio you actually maintain, 10% in one conservative rental with a property manager and a big reserve. The percentages are just an illustration. Set yours based on time, risk, and tax reality. If you're ready to take a first step in each lane, here's a simple starter playbook. Index path. Open a low-cost brokerage or use your workplace plan. Choose a broad total market index fund or all-in-one target date fund. Automate contributions every paycheck and turn on an annual auto increase until you hit your savings rate target. Dividend path. Build a short list of companies with multi-year dividend growth, reasonable payout ratios, and strong cash generation. Diversify across sectors, set position size caps, and reinvest dividends by default while you're building. Rental path. Pick one market you can know deeply, learn typical rents, taxes, insurance, and repair costs, Analyze deals with conservative assumptions and healthy cap rates, insist on inspection and contingency clauses, hold 6 to 12 months of expenses as reserves, and interview property managers like you're hiring a COO. A quick word on common mistakes. For index investors, the mistake is stopping contributions during downturns or chasing hot sectors and abandoning simplicity. For dividend investors, it's reaching for yield without understanding the business or letting a few holdings dominate the portfolio. For rental investors, it's underestimating repairs and vacancy, overestimating rent, skimping on reserves, or using risky financing that looks fine in good times and brutal in bad times. The fix is the same across all strategies. Write rules you can follow on a stressful day, automate wherever possible, and keep enough cash to avoid forced selling. Finally, motivation. Pick the lane you can love on a boring Wednesday. Wealth doesn't reward perfect spreadsheets. It rewards consistent deposits into a system you won't quit. If index funds keep you calm, lean into them. If dividend deposits keep your head in the game, tilt that way with discipline. If building and improving real properties gives you energy, do it thoughtfully with conservative numbers. The best strategy is the one that matches your temperament, your calendar, and your tax reality. And beyond, you'll still be running 10 years from now. That's the comparison. Index funds for simplicity and breadth. Dividend stocks for visible income with discipline. Rentals for control and leverage with hands-on work. Choose your lane, write your rules, and automate your next deposit before the day ends.